Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 14th, 2020. It's 12:30 Eastern Time as I'm starting the video, so midday update. We'll take a quick look at the broad markets. I have at least one trade idea, an additional trade idea. I'm considering to make an official trade. It's a speculative trade idea, a very aggressive one, but a lot of profit potential. And I think the timing may be right for it, so I'll get to that one in a second here. So we'll start out with the broad markets. Quick overview. I won't go over this too much because I did an update this morning when I got back in. Talking about the really, I'll give you some levels. S&P 500 at resistance. Still, as I mentioned, every trend indicator on the broad market from long term to the short term, all but the nearest term, the very short term obviously is bullish, but the longer term trend indicators, intermediate term trend indicators remain bearish for now. And as you can see on that chart that was posted this morning, you have a confluence of the big moving averages there are the blue and the red one, the 200-day simple and exponential, and we're still well below those. So that's how the S&P 500 looks. But what I wanted to mention, and I'll just quick recap, we rallied up today. We're at right now still at the 61.8 Fibonacci retracement on QQQ. Give or take. And I mentioned, why is that significant? I went on to say that's what stopped all the previous last couple bear market rallies. Remember, if you're not into this often, if you're not an active trader, investor, maybe you're younger and you haven't studied history. The last bear market that we had was from the highs ended last previous bull ended in October of 2007. That's when the market topped. New bear market began, and the last bear market ended in March of 2009. It wiped out about 55% off both the S&P 500 and the NASDAQ 100. As I mentioned in this post, normally the NASDAQ 100, because they're tech growth, they're higher growth rate companies, technology, they usually fall more. What happened in the last drop is the last bear market is the financial system almost collapsed. The government had to come in and bail out the banks. They were, the big banks were over leveraged and had their hand too deep into cookie jar, playing derivatives and heavily invested in the mortgage market. Housing market via mortgages and things like that, and consumer loans. It was a debt bubble, if nothing else. That's marked the last bear market. However, the similarities, as I said in there, this one was 2008, and I mentioned we had just like now, and that's the thing. It's almost uncanny. As I said, history doesn't always repeat, but it often rhymes. And so far, and then we're looking now. This is 2008 right here. And you can see that we had, just like now, we had a initial leg down followed by a minor rally there, and that one was about, I put the stats on the home page. It was comparable to this one, a little less. Remember, I've been using the term since before this bear market started. I called the previous bull market supersize, and as such we've seen, and it has played out so far, the moves of the previous corrections. Think of the drop back in 2000, the fourth quarter 2018. Think of the first leg down in this bear. Think of this bear market rally. And again, it's all commensurate to the scope of the bull market. The bubble the Fed blew by keeping rates artificially low for too long, injecting too much liquidity in the system during the last financial crisis, and then taking too long to extract that and leaving a good part of it there. And of course, that's created the excesses that that now they're trying to fix, and partly too much corporate bond issuance from companies' subpar ratings, and so that's why the Fed has pulled out the nuclear option to come in here. They created the mess, and they have no choice but to do whatever it takes to fix it. So that's where we're at. But either way, we can sit here all day long and talk about whether you think or I think the Fed will be successful in putting an end to the bear market that we're in now and bringing the market back to new highs or not. Again, that we can debate that all day long, and only time is going to tell. But what I can look at here is the similarities, and that was then we had the first major leg down ended, and then the first major bear market rally. And again, it was very comparable to this one. Both of those, both the minor and the major bear market rally stopped then at their 61.8% Fibonacci retracement. And those of you not familiar, on the first one, so you measure the move down off the highs right there, and you put up your fibs. I already did that here. I removed some of the lines to remove the clutter, and so that's a 61.8% retracement of the first drop, and then the initial entire leg down off the highs, that's a 61.8, and there are your fib lines right there, and that's what stopped it there. Now, what we need to point out here, or what I should point out, is this is a weekly chart, so you can see we hit it there, hit it the second week, third week, fourth week. It was only after 4 failures, and you can see even intra-week they tried to pop it and they closed right about on it. My lines, they don't snap to. I don't have the snap to setting on, so they could be on or off just a hair, but close enough, and you can see that's what stopped it there. And again, as I mentioned, there was another 51% downside from that point. And so I think it's very important, even if I'm beating a dead horse here, to impress the fact that as of now, and this could change, but as of now, there is not a single thing out there that, technically speaking, from the charts, that indicates this is anything more than a bear market rally. That can change. If we keep going much higher, we take out certain resistance levels, we regain trend lines that were broken, trend indicators flip back from bullish to bearish, particular certain trend indicators, key moving averages such as the 200-day moving averages on the S&P 500, and the more important indexes. Remember, QQQ is a tech-heavy index. It's roughly 50% half tech stocks, and so I often joke around, say it's just XLK, which is the technology ETF with an Amazon kicker thrown in there, because Amazon has such a large weighting in there, although Amazon's not a tech stock. It's not in XLK. It's not considered in the technology sector. And then I jump back to 2002. Remember, so this was our previous bear market. It ended with the the bull market, and that was one of the greatest in history up to that point, one of the longest and strongest, which this one just topped, the last bull market we had. That ended when the dot-com bubble burst back in 2000, and you can see I did the same thing there. I measured down. What I didn't show you on that chart was we had also, if you look really closely, though I didn't measure it, we had the initial leg down right here, and we had a minor rally which was very comparable to the minor rally that we had in this bear market early on. Then the bottom was in where we had a multi-week tradable rally right up to the button twice, stopped cold at the 61.8 fib. Now, take away from this also that I didn't mention in that post, it wasn't a one and done. We hit it once. Remember, we're looking at a weekly chart here. We hit it once, pulled back off it, and then 1, 2, 3, 4, 5, 6 weeks later, we hit it again and then reverse. So what does that tell me? It tells me, well, I feel strong, and I may be wrong on this, but I do feel strong that we're at or very near the end of the run for this rally, but more so in price than in time. So therefore, and I always say this, I get a lot of questions on the site, Randy, what do you think about buying these puts or calls? What strike? And look, I've many years experience with options, but they're not my forte. Over time, I've learned what I'm good at is calling where a security, a stock, or an index is headed, and that can be hard enough at times. I'm not far from perfect at that. Nobody bats 1,000. But when trying to not only say that XYZ stock is going to go from 100 to 150, but when it's going to get there, the timing of that brings in a whole nother magnitude of difficulty. So simply the charts could be a pretty good indicator. There are a lot of tools you can use to project how far a move may go, not only when you're going to get a move, trend reversal, that's what trend and swing trading is all about, but how far it's going to go in price. But then, like I said, and you go back for years, all the completed trades and all my unofficial trades are on the site. You can look at the analysis, and you'll see a lot of those get to those targets, and that's it, the final targets. But it's, again, on the timing of it, that gets harder, and therefore that's why I don't like to play options, because over the years I've had a lot of great calls on where something was going, but guess what? If I was just buying puts or calls, they expired worthless. Now, I know a lot of sophisticated options trading. The way to do it is use paired strategies, which then quantify your loss and gains. But again, it's still about the timing. No matter what you're doing, there's that timing element. You've got to get the move on where the underlying's going right, and you also have to get the timing right. because with options you want to keep paying for longer expiration dates. You're certainly going to pay up for that, and then you go out too far and it might not even be worth it, all the premiums you're paying, especially in this market. So all right, let's get away from that. So that's it. So what was the takeaway? Well, we're, I think, give or take, now I'm not talking within a 0.5% or even 1 or 2%, roughly probably where this bear market rally is going to stop. That's what I believe. And again, but we can be here. That may be it, or we can be here for, according to what we've looked at here between the last two bear markets, anywhere from, what did I say, 5 to 1, 2, 3, 4, 5, 6, 7 weeks. Was it 1, 2, 3, 4, 5, 6? Yeah. So that's about a month and a half. And again, that's assuming that history does, rhyme or, almost repeat roughly to the last two bear markets there. And so again, just to kind of reiterate, so we had the initial leg down right there, leg down one, little kickback rally, roughly 10% or so. The bigger kickback rally, comparable to the one we just had now, that was back in 2000. And then you had the same thing back in 2000. This was 2008. Same thing. Little initial leg down, counter trend rally, the bigger leg, and then the first major bear market rally, stopping at both of those, stopping at the 61.8, and then we go to today, and we pull let's pull a weekly chart here, and let's just turn off all the annotations and show you that's almost the same exact thing that's happened so far. That's almost the problem with this one. It's almost too close, and when you have some very clear repeating pattern, it might happen 2 or 3 times. Usually by the time you pick up on it, that's when everybody sees it, therefore it stops working. But there was our first, right here, it happened within a week, and we traded it long. We had an official long trade there on the site, and then reversed back to short for that leg down. But that was our comparable counter trend rally right there from low to high. Now I'm measuring 13%. Depends on where I click and drag, but that's about that. And then this rally here, so far, supersized, as powerful as it is, 27, almost 28% on the Qs. But again, you have to put it into perspective with the scope of the move and the previous moves. The bigger the bull, the harder, the bigger the bear rallies are going to be. So again, maybe it'll prove to be something different. But the takeaway, again, fundamentally, that I said on that post, and this one, I'm nothing short of almost shocked that there are more managers on Wall Street don't see. I guess everybody's behind Powell and the amount of money that's been injected into there. But the point I'm trying to make is from a fundamental perspective, because I could sit here, and I did early on, defended all day long about how most tech companies are not nearly as much exposed to the impact of coronavirus, the social distancing and stay-at-home orders. That's not going to affect Intel. They don't have a Intel store. You didn't go into an Intel store to buy your last computer chip. But they do a lot of their business online, and again, they're not impacted like a restaurant or an airline or even a shopping mall is. However, and this is the part I don't get, they are extremely sensitive to the economic cycle and consumer spending. Chip sales go down. When the economy drops, people lose their jobs. You don't buy that new $3,000 Apple iMac. You don't buy, you hold on to your iPhone or your Android phone a little longer. You don't upgrade. You're not buying the new, $4,000 Garmin chart plotter for your boat, because you're probably not even buying a new boat. And if you do, you're going to hold on to the old one. So all those things that chips go into, that demand falls. And because they're a very high growth industry, they go up a lot when in a bull market, and they drop a lot in a bear market. And again, you go back, so I showed you back in the previous bear market, the NASDAQ and S&P fell about in lockstep, roughly about 55% or so. But the prior bear market, and we go back here, weekly here, you can see what happened in tech. And and this is usually the case. It's going to outperform. Now, there was a dot-com bubble, but you can see the NASDAQ 100. And this is the 100 largest companies, by the way. That wasn't full of all those pets.com and any name.com back then. These were still the Ciscos of the world, the Microsoft and Apples and all that back then. Keep that in mind. And they still fell 83% versus the S&P 500, which fell a lot less because you have S&P 500 is a well-rounded index. It's 11 different sectors. So it only fell about 50%. I say only, again, you have to put these bear markets in perspectives and just do that whole mapping thing like in the shopping malls when you go, we are here, we are here. If this is coming, then there's a tremendous amount of profits to be made on the short side. If you're a believer that the Fed has, the power to, change the course, well, that's it. If they can do it now and there's not any longer term consequences, then guess what? You ought to put all your money, 100% stocks, no matter what age you're at, defy all rules of investing, because we'll never see another recession or bear market again. So anyways, I just wanted to go over those, that's where we're at, and then let's look at the shorter term charts now, because that's probably more important. I gave you, that's the longer term outlook, and my fundamental ramblings. I've been doing that quite a bit lately. All right, so here's the S&P 500 or SPY trade and the S&P 500. Whereas the last update I would have had right here showed you we had a divergent high, a little wedge breakdown. Nothing technically has changed. When you break down from a bearish rising wedge, it's either that's it, you don't look back, the correction begins, or sometimes you get a kickback rally to go on to either back test the wedge or make a marginal new high, and then you go down. As of now, this is a marginal new high that has only simply extended the previous negative divergences that were in this place. So I've added this line here, and I just dragged this line. I did this. I've been doing this on the weekly charts for over a year now, and it finally played out. And what I often say, the bigger the divergences, the bigger the drop. And that's certainly held true on the long-term divergences on the weekly and monthly charts that have now started to play out for the biggest drop we've seen in such short order in the markets in decades, if not history. And we've seen that on the daily charts and everything else. Problem with divergences is two problems. Number one, I always say this. Number one, they're not a sell signal. They're just merely an indication of a trend reversal. But we did get a sell signal here, so I think we're still on that sell signal. And number two is that sometimes they are taken out or burned through, meaning prices continue to move higher like this. And let's click on this. Prices go higher, and then the indicators move higher, and then you no longer have a series of equal or lower lows versus prices making higher highs. Lower highs here. That's what negative divergence is. Lower or equal highs on the indicators with prices making higher highs. So again, that's what we're looking at. But right now, and somebody asked on the homepage, I'll get to a couple of comments here about the stop. Remember, I've a lot of trades I've moved the stops recently, or I've set them even from the get-go to stops based on a daily close. And again, this is where I want to talk about whether I decide to modify them again. This is not normal. Rarely will you see me modify a stop more than once on a trade. Rarely do you even see over the years, out of 100 trade ideas, official trade on the ideas on the site, every 100 I might modify the stops. Again, going back a decade or more, maybe one or two, if that, out of somewhere around there, 1, 2, 3, well under 5% easily of the official trades do I ever pull, suspend, or extend a stop. I might raise it. I'll often tighten up a stop, especially as the trade goes profitable, but rarely do I open it up. Generally, that's sloppy trading. You're not sticking with your trading rules. You're allowing for larger losses. But again, this is a very dynamic trading environment and with big swings. And what I'm doing right now on this trade, it's not a quick pullback trade. It's to capture a potential larger trend. So I'm treating the active trades closer to how I actually trade my own personal account, and that is if the charts tell me to, I'll modify the trading plan as long as the trade still looks good and I see other things there. Where I'm going with that is you may be getting whipped around, you may be past your comfort level. I've been doing this long enough to know, no matter how many times I talk about the benefits of diversifying among different positions, among different asset classes, and most importantly, not putting too much in any one trade, people still do it. I get that all the time. I'm feeling so much pain. I'm underwater. What do I do? They buy leverage, 3-time leverage ETFs, or put all their money in a QQQ or SPY or semiconductor short, and now they're down 10-20%, not on the position but on their entire account. Again, I can't speak to that. That's just bad money management. On the SPY trade, for example, right now, we entered it, this one at 273.17, and I do have to say it's a tag on to that QQQ trade that was stopped out. I didn't get to close that one, but it's about 3% above, so nobody should be feeling pain on one position that makes up only a certain amount of their entire trading account or portfolio that's down 3%. But and again, even if on the QQQ short trade where that one was entered, if you're still holding that one might be down 8-10% even. But again, it depends on if you're shooting for, as I just showed you on those bear market returns, if you're shooting for the long term on QQQ, which I'm more and more starting to warm up to, is what's probably going to outperform on the next leg down. Right now, I'm still putting a little bias on the S&P 500 because I think the financial stocks have come up too fast. I think there was a huge short squeeze when the Fed came in last Friday with the backstop, for the credit markets and the banks and everything else. But longer term, we put them back on the lines here. QQQ from here could easily have another. Well, let's just say to that target down there, that's about 33%. And if we get back to those 2015, 2016 highs where the Dow and a lot of other sectors and indexes sectors and indexes got, that's about a 46% drop. And that would be just, run-of-the-mill bear market compared to the scope of the preceding bull market. That would be from the highs about a 50% drop. So that would be less in just percentage terms than the last bear market. And in as far as retracements go, now you want to really, talk some scary numbers. And I'm not saying we're going to get there, but I'm just saying it's possible. Let me find a clean board here and try to. Here, let me do this and get away. I have so many boards marked up with different things on there. Just do a Fibonacci let's see the last bear market when you look from high to low right there in the previous bear. Of that was the bull market preceding the last bear market. And I need to put on a 78.6. That's probably where we're going to come in at. Yep. All right, so you look from the lows back here, that's when that bull market started back in 2002, ended in 2007, and so that last bear market wiped out or retraced. That's a 78.6% Fibonacci level, so there it is, about 80% of the previous bear market. We go back to the other one back there, and might have to move this. Let's see, I think that's about where, mid-90s, that's about where it started there. And you can see that one retraced more than 80%. So far from the lows back here, and we'll go off those March lows. NDX, technically speaking, bottomed in the fall of 2008, whereas every other index out there, the Dow, the small caps, mid caps, S&P 500, Wilshire, you named it, all bottom in March of 2009. And again, the NDX is it's not a diversified index. It's really a play on tech stocks. But we trade it a lot because there's a lot of, it led the way up. But where I'm going with this is, look, there it is. So far, we retraced not even 30, well, we have to use that low to be technical. You're putting a fib, you have to hit that. Excuse me, yeah, you have to hit that low from 2008. That's a proper use of Fibonacci up to the high there. We haven't even retraced 38%, the minimum fib retracement of the previous bear market. So again, if you want to look at where things could go, I certainly think this could be, or we followed the path of Japan leading up into the early 90s, and you can just do a Google search of the Japan's lost decade, and then read up on the similarities of our credit bubble in theirs that they had back then, them going to a zero interest rate policy, and then look what happened to their stock market over the past really 3 decades now. Okay, enough rambling. Back to the charts. 60-minute chart, SPY breakdown, little kickback rally. Still above the right now above the daily stop. I'll let you know before the close today. I'll let you know if I see enough to extend it again. If I let that trade close out officially, it's up to you if you want to stay with it or not. I can tell you personally, I'm going to hold on to all the swing positions I had, and I even added to those positions today after I got back into the office after the market opened today. There's SPY, QQQ. Same story. We had, I don't know why it's not drawn here. Sometimes these lines just seem to disappear. We had a divergent high back here, a little wedge, broke down. From that divergent high down to the low, that was about a 7% drop right there. And right now we have almost an identical pattern. We have a divergent high, rising wedge pattern. There's your negative divergence. There's your trend line and a pretty big support level right there, 203.29. It was resistance, big level that the bulls want to see hold. If this is the real deal, that level was a big gap back here, a failure on the back test or back fill of the gap. Tested the gap again, failed, tested again, failed, tested again yesterday at the close, popped it today. This is a breakout. Bullish on face value. This would be a fake out, meaning a false breakdown. A drop below 203.29. It would also take us below this potential uptrend line there. So that's for the bearish scenario. Bulls can, if they can take this and run, you can see still plenty of resistance overhead. And again, I do this video because this is a 60-minute chart. Big picture. This can happen this week. This can happen this. But, where do we close the day? Where do we close the week? When you're trading on a weekly chart, really all that matters are the weekly candles. If you put a solid weekly close way up above that 61.8 fib, we've taken it out, and it certainly chips away. It doesn't eliminate, but it certainly chips away at the bearish case. Until then, I'll say it clearly, I view this as one of the potentially one of the best shorting ops in decades as far as a risk reward perspective, because if we are at the tail end of a bear market rally with another leg to come now, we're talking, let's just say you have no position. I'm talking as of today, whether you're in it or not. When I say one of the best shorting ops from a risk reward perspective. So let's say you short here and you allow yourself, let's say 6%. Stop. And because you're going to swing, you believe this to be a bear market rally, and you're going to target, let's say, down here. This is a potential target I think we're going to before all said and done, 143.50. You're talking then about 32%. All right, so to me that's better than a 5-to-1 RR. Very, very attractive risk reward ratio, very attractive. And again, everything in the markets entail risk. So you might risk 6% to make 32% or even more, depending on your outlook for the market. Quick look at the futures, then we'll roll in and give you one trade idea, and we'll wrap this up. All right, they have a 60-minute chart, wash, rinse, repeat stuff. This is since the bear market rally started. Really, since the lows back here in late March, mid-March. We had divergent high, nice drop there. We extended the divergence, another drop there, and then corrected a little more. And after correcting in price, we corrected in time to work off those divergences. Went up here, had a small, call it baby divergence, even just on the RSI, little baby correction there. Put in divergent high here. We had divergence there. I probably would have drawn that out, but we've simply extended the divergence line. So those are, they had a little correction there, but we stayed above this trend line right here. So let me erase all those and just tell you what the salient lines and levels on this chart are. Here's our current divergence. It's only extended, much larger, even larger than back here. This one we really didn't have. That line shouldn't be there. That one's not there. Yeah, that was higher high. This was their divergence. We didn't even have RSI divergence right here, only right here, leading up to that one. Here we have RSI and PPO divergence, and we have a minor trend line there. It's comparable to the one I think I gave you on QQQ. with this trend line likely to come into play. So if you are trading, oh, one big level here. All right, there it is right here. That's comparable to the breakout in QQQ. So let me make it very clear for you NQ traders. I think this is probably the most important level right now on this chart, about 83.29, because that's comparable to the breakout in QQQ. You can see all the resistance there, popped above it. So if we break, you have this minor trend line. It would break the wedge. That would trigger sell signal. Come back here. I'd be surprised if they didn't buy at least the initial tag, but if and when that breaks, which I expect, that's a pretty powerful sell signal, because that is a bear trap, aka false breakdown. We had the false breakout. We had a breakout right here. If we drop down below there with conviction, you know, more than just a little pop down, because remember, that's why I do all these videos. There's so many nuances here. And we can break 83.29, but then you have a pretty decent trend line coming in just below. So if we do that, and often when you break out, it's not unusual to see a back test come in a little bit below the actual level. It kind of runs the stops on everyone that stepped in to buy here. So there's your bullish scenario for you bulls, in a very objective place to buy with a stop somewhat below. And for you bears, wait and see that trend line go with conviction, and that should be a pretty powerful sell signal that I think in the near term will bring us back down to right here at least, and that's 73.74. What is that on NQ? That would be a drop of about 15%. One contract to NQ would probably put 10 grand or more in your pocket, you know, on a 15% drop there. Oh, and I also want to mention too, this would be a first target somewhere where I'd expect a reaction as well. I can see a little candle there. Nice, you know, resistance right here. We had a breakout, successful back test again. So this is the path that I would, you know, trade. Actively trade, you know, if you're actively trading, all the reaction points there, reaction there, and then ultimately a move down there. So tradable bounces along the way. That's kind of a rough path now. And again, it all charts are dynamic, so I'd look at, you know, how the 5, 15, 60-minute charts look for support levels on the daily, keep an eye on QQQ, SPY. Again, there's so much that goes into this. It's not as simple as, you know, buy here right now, sell if that breaks, you know, and trade along this way, but that is sort of the my preferred scenario, let's call it right now. And then for ES traders, nice clean trend line right here. You have uptrend line on ES, and I'm on the 60-minute chart just like I was on QQQ a second ago there. There is your wedge pattern. We broke down, we back tested it from below, and we just continue to back test while setting up with this minor trend line. So here are your levels right now for ES traders. You have a sell signal to come here. We pretty much we're on a sell signal right now. We've just made a slight marginal new high, and that's one other reason I may just you know, extend the stops on the SPY trade, because it still looks good. The S&P 500 still, to me, you know, we had this recent sell signal, divergent high, and like I said, sometimes you go and that's it once you break down, and sometimes you back test, make a marginal new high. As long as those divergences are intact, which they still very much are, the SPY would have to do quite a bit to burn through these divergences right now, or ES I should say. And so here it is. Sell signal number one comes on a break of this minor trend line. That should take us down here. I see very minor support. I'd be doing a disservice if I didn't add it right here. There's some minor support that may come into play about 27.31, but you know, favor a move down here to the 26.96 level right there. And that would be an initial target, pullback target for SPY on a breakdown. So something along these lines, reaction there, you know, another reaction there, and then a move down here to at least 26.26 minimum. And then this would correspond with that longer term target I gave you on the Qs, about a 15% drop on NQ, and that's 24.60. So there's my near term and intermediate term targets. Should we go back down to 24.60, that would be about a 13% drop in the ES. Okay, changing gears. Sorry, I had to take a phone call there. It went a lot longer than I thought, so I can't even remember where I paused the video a second ago here, but I'm picking back up, and we're going to move on and wrap this up and just give you the trade idea that I was talking about here. This one is going to be a little more aggressive now. It has to do with gold. Gold is an active trade on the site, has been for a little while here. We are at here's the gold current trade. We entered here at 139.12 back here on this candle. I am on a weekly chart. I need to be on a daily chart here. We'll go here. There we go. That's it. So we entered right here, somewhere in here at 139.12, and we hit our third target, but we still have, it's up so much higher that I have to move the chart down. Fourth target up there. It's, again, gold was added as a trend trade. You know, this is, gold's been in a bull market, and you know, so we're looking for, have been looking for the next leg up after this correction here. That's why we position, and that's what we're in right now, and it's pretty clear. We've now taken out those highs the other day that I talked about, and continue to build, and you can see the divergence. In this case, we had divergence the other day, as I mentioned on here on GLD daily, and now that's been taken out, because you can see here the PPO has moved higher. Be nice to see that PPO signal line also take it out, the white line, because you can turn down here and you still have the RSI divergence. But as of now, it looks good. Just want to say that. And then on a related note is this little one, XAUMF. This is a Canadian company. For you Canucks, the symbol would be XAU.TO. Well, not, you don't have to do the TO. .TO means it trades on the Toronto Stock Exchange. So you can go on the TSE, and I believe the symbol is XAU. This is Goldmoney. Here, let me give you a description real quick. This is Yahoo Finance. You can find other sources out there to tell you what it's all about. 78 employees. In description, Goldmoney operates as a precious metal focused investment company worldwide. Company is involved in investment custody and storage of physical precious metals through goldmoney.com online platform, and gold and silver collateralized lending and borrowing through lendborrowtrust.com, as well as coin retailing and lending, blah blah blah. It goes on to say they you know, they deal with you know, all kinds of, you know, gold, and the gold is obviously rallying. That's what made me go look at this one. I've had a position in this one, a small one, for a while, and I'm looking to add because we may be breaking out here soon. You can go into, you know, the financials and look at this company. It looks like it just had turned profitable last quarter. If I go here to quarterly, we can see you know, we started to go to where was it? Gross profit, total operating expenses, income or loss right here. Last quarter that reported in September 19, you can see we've, you know, this company has gone to you know, positive income here from 2 previous quarters of losses. So, you know, fundamental, I really don't know much about it fundamentally. You can do your digging there, but I can tell you from the charts and the fact that gold is rallying should be beneficial for this company. And you can see right here what the big level is. It's at $2 roughly. You can see, go back all the way. This company started trading at least back here. That's where the chart history goes back to. And what I'm going to show you is numerous reactions on that level to help validate that as a significant technical level. We had a reaction here, 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 couple there. We broke below it briefly, but then it was a false breakdown. Remember, that's very bullish to see a failed breakdown. Is a, we call that a bear trap. Bears pile in short when that support level breaks, and when it back then it must have been pointed out as a bearish setup on the site. Yeah, bullish setup. I'm sorry. We had positive divergence and everything. So we broke out. Boom, 240% rally right into the divergent high, which then set the stage here. We put in a divergent low. It's a volatile little sucker. This is a small micro cap company, high risk. I cannot emphasize that enough, but a lot of upside potential. From that divergent low, that was about a 72% rally. This was a quirky one-day drop. We really, most of the trades occurred down to about here. We pretty much tested that low. I looked on, you know, a shorter term chart. You can see right there, see that one wonky little candle. So like I said, maybe one trade, somebody had a limit order or something that filled right there. Don't know what happened there, but either way, even if I would have done this, you still had a divergent low. So I like that. We're coming off a big divergent low. And again, that $2 level, as you can see, it was support for a while. When it broke, support once broken becomes resistance, resistance, and resistance. We had a little failed breakout attempt here recently. but we pulled back, hit that 170, 163, 164 support, bounced back, and we're trying to clear, or the stock's trying to clear the $2 level again. So this would be really an objective entry here with an objective add-on if and when that recent high around 224 gets taken out. Price targets on this one, I could easily see this one running up here to 252 level if this breakout holds, especially if we clear that 224, and also easily coming up here to the $3 level. What does that mean in percentage terms? Well, about a 50% run if we get there. You know, potential longer term target up there around 467, maybe a stop or two along the way. But so therefore, I may throw that one out there because again, you know, I've been bullish on gold, and this is a little kind of niche company. Again, very small, high risk. So do your own due diligence and pass if it's not your cup of tea. All right, let me wrap this one up. I'll get this out to you guys. If I do make this an official trade idea, I'll make it very clear just how aggressive this is, and you know, I'll probably have a considerably, you know, considerable downward adjustment to the beta adjusted position size. In other words, you don't put as much into this as you would put into Amazon or SPY for a trade. You put a lot less because your upside profit potential is a lot more, but then again, so is your downside risk. You can try to manage these kind of trades, you know, with a stop, as you should. However, at the end of the day, little small companies like this with questionable financials can just sometimes you wake up to a big gap down that can bypass even the best place stop. So that's why you, at least in my opinion, never put too much into a speculative trade like this. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.